Okay, let's jump right into this explainer. If you've ever been totally blindsided by a massive, violent price spike right in the middle of your trading day, well, you're in the exact right place. Today, we're uncovering how professionals actually use the economic calendar to survive market chaos. We're going to break down the disciplined, mechanical risk management rules that separate the real pros from the gamblers.
You know the feeling, right? You see an incredibly positive jobs report hit the wire, only to watch the market instantly nosedive and liquidate your long position. It's beyond frustrating. But the core problem here is that the market is a forward-looking mechanism. Trading the news based just on a headline can instantly wipe out an unprepared trader, because you are reacting to what just happened, while the institutional money is already pricing in what happens next.
Section 1, the risk management map. So, the absolutely crucial point we need to shift right off the bat is this. We are not trying to guess if the market's going to go up or down. That's a huge trap. As our source material lays out so perfectly, you've got to view your economic calendar not as a crystal ball, but as a risk management map. We are simply pinpointing exact moments of danger. Trying to predict direction, that's gambling. But identifying volatility, now that is mechanical risk management. Your calendar is literally telling you when the market will move violently, not where it will go. By tracking these scheduled events, you can actively avoid getting caught in unstable conditions, or you can adjust your existing positions so you don't get completely wrecked by massive price swings. Section 2, decoding red folder events. Let's filter out the noise to find the real threats.
Look, the biggest problem most new traders run into is total analysis paralysis. You pull up a calendar and you're staring at dozens of daily data points. It is completely overwhelming. But the fix is actually super actionable. Heavily filter that calendar. See, low-impact yellow and gray events? They rarely move price. Orange medium-impact ones might cause minor fluctuations. You only want your calendar to show the high-impact red-coded events, like non-farm payrolls or FOMC meetings. Those red folders are the ones with the power to jump price right over your stop loss and cause massive slippage.
But why do these red folders cause such absolute chaos? It all comes down to one thing: the surprise. When you look at your calendar, you'll see a forecast column, which is what analysts expect, and an actual column that stays blank until the exact second of the release. The market usually prices in that forecast well ahead of time. So that severe, violent volatility you see, it's driven entirely by the surprise variance, the gap between what the market thought would happen and what actually dropped. Now, here is a massive key takeaway for this segment that catches so many traders off guard. You always have to beware of revisions. You might see a fantastic actual number that totally beats the forecast, yet the market aggressively sells off. Why? Well, because you didn't check the previous column. Frequently, agencies will quietly revise the previous month's data downward. So a great current number paired with a terrible hidden revision totally changes the whole context. Always watch for that little asterisk. Section 3, the pre-release freeze. Let's talk about when liquidity completely dries up. Have you ever wondered why traders get chewed up and lose it all in that weird quiet before the storm? It's because the institutional algorithms actually pull their limit orders right before a red folder event hits. The big money literally steps aside. Let's break down the mechanics of this pre-release danger zone. What happens is you get a massive drop in volume, stagnant price action, and incredibly thin liquidity. And that thin liquidity artificially widens the gap between the bid and the ask price. That means if you try to enter or exit a trade during this freeze, your risk of massive execution slippage goes through the roof. The solution? It's strictly mechanical. Professional traders will close out short-term intraday positions, or at the very least, move their stop losses to break even long before this freeze ever happens. Your key takeaway here is to accurately plot these volatility zones directly onto your high contrast charts, so you are never, ever caught inside a freeze. And for mapping these events properly, we want to thank TradingView. Save $15 using our referral link in the description to get the standard in charting. You absolutely need a fast, reliable visual representation of where price intersects with time, and TradingView delivers exactly that. Moving on to Section 4, post-release market stabilization. Let's look at the immediate aftermath and how to avoid getting chopped up. The core problem we face here is the violent, non-directional volatility right at minute zero. We call minute zero the whipsaw. This is where price spikes violently in both directions, basically hunting stop losses above and below the current range. Then, by minute 5, we get some initial digestion as the market processes the actual data surprise.
And finally, around minute 15, we start to see true stabilization, where the real tradable trend finally emerges.
The only actionable solution to survive this is applying what we call the mechanical step-aside rule. You literally just step aside and wait 5 to 15 minutes post-release before you even think about looking for new setups. Your ultimate takeaway here is that watching how the market closes a 15-minute candle after the release provides infinitely more edge than blindly trying to chase that initial spike. Let the market show its hand first, guys. Section 5. Building your weekly routine. Let's make this bulletproof. A huge problem traders face is just getting caught off guard mid-week by a scheduled report they totally forgot about. The simple fix is treating your economic calendar as a mandatory Sunday evening briefing. It's just 4 easy steps. First, synchronize your time zone so you avoid those brutal daylight savings errors. Second, filter out all that low-impact noise we talked about. Third, locate the big 3 volatility drivers for the week. We're talking central bank rate decisions, CPI inflation, and NFP employment data. Literally write them on your desk calendar. And that brings us to step 4, which is a massive takeaway: identifying pre-announcement dead zones. Think about it. If a huge Federal Reserve rate decision is dropping on a Wednesday afternoon, Monday and Tuesday might offer absolutely zero trend clarity. They are essentially dead zones. So your goal here is to avoid forcing low probability trades during these stagnant waiting periods. Conserve your mental capital for when the environment is actually stable enough to apply your strategy. Okay, let's bring it all together in Section 6, charts, calendars, and action for our final, most critical rule regarding intraday positioning. The crucial point we've been building toward this whole explainer is the ultimate mechanical rule. If you are an intraday trader, the only actionable solution to definitively protect your capital from unpredictable spikes is to be totally flat. You must hold absolutely zero open positions when that high-impact actual data hits the tape. Sure, swing traders with super wide stops might hold through, but strict, disciplined scaling rules dictate that day traders step aside completely. Your calendar provides the exact countdown you need to exit gracefully. And look, to really implement these exact mechanical rules, dial in your contract sizing, and scale your trading professionally, make sure to grab your copy of the Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. It dives super deep into the specific scaling rules you actually need to survive in this game. So I want to leave you with a thought and let it really sink in for a moment. Look honestly at how you traded last week. Is your economic calendar acting as a risk management map that actively protects your capital? Or are you basically using it to gamble on the news? Implement the step-aside rule, respect those dead zones, and stay completely flat during red folders. Apply these mechanical rules, and we will see you on the next explainer.